Welcome to Tawaga webinar. So Pratik, idea was so it's a series called Crystal Gazing: The New Normal, where we are just
Okay.
trying to get thought leaders like yourself and just trying to see how does things change in the new world. Whatever you have done thus far probably doesn't even count now. So how are you looking for next few years going on panning out on various fronts, right? So the idea is to have it a very generic chat. On investments, on exchange traded funds, on passive funds. But happy to get your thoughts on anything else that you think is relevant for our viewers to know,
Sure, sure.
whichever ways you think about it. So thanks again for having us. So all yours. I mean, your thoughts on the new normal. What's your take initially?
On I mean, I can give a short background, or maybe for our viewers, I can give maybe a short description of what passive funds are, what index funds are. I don't know how is the concept really very different from investing elsewhere. So just to give you a background, so I got introduced to passive funds when I was working at a startup in Silicon Valley. So I was heading operations and finance there, and we were basically taking this very simple S&P 500 or Nasdaq or like those sort of passive funds and creating a option strategy on top and selling it to advisors. So it was a very popular product, and I think that's when I really realized how simple these products are and how scalable they are and how easy it is for a customer to hold these for a long time in their portfolios. So that's when I sort of learned about passive funds, and then when I came back to India, I thought that there was not a lot of depth in the passive fund space in India, and this was in late 2018. There were a bunch of ETFs, but liquidity was quite poor on the exchange, and also the index funds. I think not many people were sort of knowing what index funds were. So the idea behind passive funds, honestly, for me, over the last 6 months, have just been going out there and educating people about what passive funds are, what index funds are, and how are they also a very good alternative to the other funds that they continuously hear about, out there. So that is how it came out, and I think if you look at passive funds today, we usually only had large cap funds say a year and a half ago, but today if you see they have options in all categories. So if you look at our own AMC, the Motilal Oswal AMC, today we have passive funds across large cap, mid cap, small cap, multi cap, and international, which I think is a huge segment, which will probably cover over our session. But essentially, I think the reason why I think passive funds are great, and from a historical perspective, we look at funds that are 40, 50, 60 years old. All of these funds that we talk about today in the US, not in India, because that market is a lot more depth. You're looking at these funds that have survived 30, 40, 50 years. And they've also not only survived but also thrived. You have invested, and the same time period, 40, 50 years, you had, I think, maybe 3/4 or maybe 4/5 of all other funds that have either closed down or merged. So someone who is looking to say, someone, if you are a 25-year-old or a 30 or a 35-year-old today, if you're looking to invest for retirement, it's very hard for you to select one fund manager or one strategy, which is why index makes a lot more sense. You keep it simple. Your investments will be in that fund for many years, and you can expect really good returns, because what we've seen is today, I think the returns of active versus passive are pretty much on par.
Yeah. So, I mean, that brings me to the question, so why, I mean, if these are such a beautiful products, why have they not taken sort of off thus far? What's stopping the market to grow in itself? Or is the undercurrent already there, which we are not realizing right now? And, you'll see more and more sort of people gravitating towards that in the new normal world that we are going to see.
Yeah. So, it's a very good question. The undercurrent is there, but at the same time, it's not there. So, I'll give you an example. If you look at passive funds, say 5, 6 years ago, they were merely, I would say, the entire AUM of passive funds was 5,000-6,000 crore. Today, it's looking at close to 1.7, 1.8 lakh crore, almost a 40x, versus the mutual fund AUM in India was only grown maybe 2x, 2.5x over the last 5 years. So I think growth has come in a very big way. But growth has only come from a few participants, so mostly pension funds and government entities. So that's what's driving the demand for these products today. If you look at the HNI retail world, yes, there's a lot of traction happening in retail because of more awareness. But essentially, if you look at the Indian mutual fund space today, mutual fund is a sole product. No one really goes out there, and I mean now obviously that trend is changing. But historically, I think mutual funds are sold product, and there is really not a lot of incentive for anyone to sell a passive product because the commissions is close to half or maybe one third of other funds out there. So I think because it's a push product, because I think a lot of people don't have the incentives. You haven't seen as much of I would say push on these funds, but and I think that, and also historically, now it's obviously different. But if you look at say 5 or 10 years ago, I think the performance of a lot of these active funds were actually quite good. So I think there was no question about investors looking at passive, but I think that is changing slightly. I think, and it's tilting more towards I think having some allocation towards passive.
Yeah, fair enough. So why do you think that cost should matter? Really for retail investors. Why bother looking at index funds, over active managed funds? Because I mean the popular perception, right? So I'm not referring to statistics here or numbers here. I'm just saying that the popular perception is that active managers massively outperform and everything, and hence you pay them a fees and everything. But why should a cost matter to retail investors? Can you elaborate a little bit more on that front, please?
Sure. So one of the guys who pioneered passive funds, the guy called Jack Bogle. He started this company called Vanguard, which was a startup in 50 years ago. Now it's the world's largest mutual fund. And what he said was very, I would say, insightful. He said, I think the guy who makes the most amount of, at least who makes the most amount of wealth over the long term, is not the person who selects the right fund. He makes sure that his costs are low and discipline is high.
Yeah.
So I think if you keep your costs low and if you keep your discipline high, that will ensure that you will create wealth over a long-term period. So I think cost is extremely important. If you look at, I would say, passive funds. If you look at the philosophy of passive funds, you're getting average returns, you're getting mediocre returns, you're getting market returns. But if you look at these medium returns on a low cost basis over say 10, 15 years time, because you're saving on cost, you're actually over time actually coming in the top 1 or 2 quartiles in terms of the returns of a lot of these funds compared to other funds.
Yeah.
So I think India is not as mature, but if you look at more mature economies such as the US, where obviously India is headed, there the S&P or the Nasdaq, two of the big indices, they must have, I would say, beaten most active funds by 91. I think they've beaten 91% of all other active funds over 15-year period. And that 15-year period is basically average returns at low cost.
Yeah.
So by saving fees, what you're doing is you're enhancing your returns in a very big way. And the longer you invest it, the better and more effective your returns go up. So I think, which is why I think, it's a very long-term philosophy.
Yeah.
If you're looking to buy passive funds for 1 or 2 years, it's not going to really matter. Fees don't matter. But if you're looking at it from a long-term allocation perspective, then yes, fees do matter.
Yeah. So are you referring that probably exchange traded funds or passive are more long-term buy and hold sort of a products rather than trading on short-term trends? So really, if I have a huge call on Nifty 50, probably maybe that's not the right strategy to think about it. Probably playing it through mutual funds or stocks perspective, might be a better strategy. What's your thought on that?
No, I think, I mean, it can be both, So I think effectively, I think ETFs make it easier for, so, if you look at the history of ETFs and index funds, obviously ETFs are a lot more popular in mature markets today. But if you look at history, ETFs came in, I would say 15, 20 years later after the institutions start coming in. And if you look at institutions, they like trading, they like buying in the morning, they like selling in the evening, or they like, they want that perfect price at that point of time. So ETFs got very popular. So I do feel that, obviously if someone wants to take a call on the broad indices, then ETFs is obviously a lot better route than say an index fund. But also I feel that someone wants to take a long-term call, then ETFs is almost as good because, I mean, assuming that the ETF tracks the market really well, assuming that the ETF has low tracking error, assuming that the ETF is managed well, then I think investors should not really worry about choosing between anything ETFs or index funds. Just I would say, I think just make sure that investors look at the NAV, make sure that investors get a good price, because what at least I've seen at our AMC is that the price between the ETF and the underlying is sometimes there is a mismatch. So investors when buying ETFs should just keep that in mind. But apart from that, I think both are, or ETFs are also could be easily looked at as long-term investment tools.
Yeah, fair enough. So, I mean, for our viewers, Pratik, who are mostly retail investors, I mean, why ETFs over index funds, or why index funds over ETFs? There's such a fine, thin line, So how do you sort of differentiate, and why should you differentiate even for that?
Yeah, so I think ETF is honestly both are, I would say, good instruments for long-term investing. I think they it's not apples versus oranges at all. Both are actually different type of apples.
Mhm.
So I think both are good instruments of buying and selling. It's just that ETFs in India, they haven't really as evolved as say ETFs in the West, which hopefully they will get there over the next 5 to 10 years time. So I think both are almost as good. I would say, I think ETFs might make a little bit more sense if you're looking at 10-year plus investing, because your expenses are slightly lower on ETFs. But at the same time, I think, people need to understand that it's much harder to set SIPs on ETFs.
Mhm.
Sometimes you might overpay while buying, sometimes you might undersell. So I think index funds are obviously simpler, but I think overall, I don't see any large differences between buying ETFs or index funds. Whatever the index, it depends a lot on the customer. If the customer wants to buy it at different times of the day, then obviously ETF makes sense. But if someone just wants a simple product where they can do SIPs, don't have to worry about, I think a market maker or a broker, then obviously index funds are a lot simpler.
Mhm. Fair enough. Pratik, you did refer to tracking error on ETF. Now, I mean, we've been huge fans of Motilal Oswal funds. Nasdaq 100 is a great instrument. That we love. Sort of to give exposure to our clients and everything. But before we jump to individual instruments, maybe you can cover a little bit about the tracking error, and especially around March and April. The way market makers. Sort of didn't really perform up to the mark. So what really changes from you in the new world, that how do you intend to address that issue of market making in the industry?
Yeah, no, it's a good question. It's actually quite concerning, I'll be honest, because market makers. I think today, even though I think most AMCs have a, I would say, commercial arrangement with authorized participants or market makers. I think there was at least looking at March and April. Not to be very technical, but I think what happened was there was a rebalance that was due, and Yes Bank was supposed to be removed out of that rebalance, but because of regulatory reasons, AMCs cannot offload that stock. It had to be in their portfolio for 3 years. So
Yeah.
that actually seized, that caused valuation issues because the index was somewhere else, but the portfolio was someone else because of the Yes Bank holding.
Mhm.
So I think that's what caused a lot of market makers to actually stop working altogether,
Yeah.
which is why a lot of ETFs were trading at 5%, 10% above, and 5-10% below. So I think it's a very scary thing, and I do think that a lot of market makers are not maybe not may not be as enabled to be able to provide a good price to investors during volatile times. So
Yeah.
I think that is just what my learning. Hopefully, things will get better, but that is the reason to why you saw huge mispricings in the industry, especially in April and March. Index funds make it slightly easy for this. Index funds, you don't have to worry about market maker or broker on exchange. You just have to go out there, and the AMC will give you units the next day. So I think it's a lot simpler. But if someone wants to, obviously buy an ETF, then he needs to keep in mind that he needs to make sure that the NAV and INAV are very close to each other, especially for domestic funds.
Fair enough.
And sorry, in terms of tracking error, I
Yeah.
forgot to mention.
Yeah.
So tracking error is something which is inevitable. Every fund, every index fund will have a tracking error.
Mhm.
Every in the world. So I think tracking error is something which is part of everyone's portfolio. I think it's important for AMCs to manage tracking error pretty well. Obviously, in today's time, I think tracking error is with today's sophisticated, I would say, trading technology, and I would say with brokers. I think more or less tracking error should not be a big issue for most funds.
Yeah.
Also, the expense ratios of tracking fund of these index funds have come down dramatically over the last. So expense ratio, I remember, used to be around 1.5-2%,
Yeah.
around 3 or 4 years back. So I think due to good regulations, the expense ratios have come down. So tracking errors have come down by a huge amount.
Mhm.
But I think when you look at tracking error, it should be basically because of, I think if you had to estimate tracking error for your investment for say 5-10 years, just estimate your expense ratio as the tracking error. So if you end up paying say 10 bips or 20 bips or 30 basis point, then you should estimate that much amount to be a long-term tracking error, which I think is quite healthy.
Yeah. I mean, no way it can come down further
From
from these levels, 10-20 basis point levels.
no, yeah, you can. So so once AUMs increase for a lot of mutual funds, they can do stock borrowing and lending. I think, and what happens is because of regulations, whatever money you make on stock borrowing and lending gets invested back into the fund. So yes, you can do that, but even the SLB market, is not as developed in India. There's not a lot of demand and supply. So
Yeah.
hopefully over the long run, like in the US, for example, you can easily lend billions of worth of securities every day. Super simple. India, I think it's still not there, but I think with that market growing, you can expect it to come down even further.
Mm-hmm.
But I mean, 10 basis point is nothing here. I mean, think
Yeah.
about it. It's like over 10 years, 1%
Mm.
underperformance. So if you're making 250% in 10 years, you're making 249%,
Yeah.
which
Yeah.
I don't think makes much. So I think it's already quite low. I would say the costs in India already are, I would say, lowest. I would say pretty low if you compare to global standards.
Yeah.
I think the average expense ratio for Vanguard or an iShares would be around 25-30 basis point for their funds. So we're already, I would say, at that level. So and we don't have their scale.
Yeah. No, fair enough. Thanks, Pratik. I mean, that was very helpful on understanding the ETFs, the market dynamics, and so on. I'd like to jump on second part of this, sort of session webinar. And I mean, on the same time, I'm reading through the questions which we already received from our viewers, and hopefully we'll get more questions, as we proceed further in the call. But one of the questions that we continuously get asked is around diversification. Now, I would love to cover your S&P 500, sort of exposure versus Nasdaq 100 exposure as well. But help us understand, for a layman, what diversification really means. What does it mean for you effectively? Is it just like buying 100 stocks in equal weightage, or is it just like buying across? Open to your thoughts about what. I mean, help us understand, what diversification really means here.
Yeah, sure. It's a very good question. What is diversification? Most people feel that, at least from what I've learned, most people feel that if they spread their bet in 5 mutual funds, they're diversified.
Yeah.
This is completely not right. It's completely false. I think the idea about diversification is to invest your money in non-correlated assets. Just to put that in layman terms, is to put in assets that move in different directions.
Yeah.
If you look at equities, they move in the same direction. Today, a large cap fund and a small cap fund has a correlation of 90%. So they move pretty much in the same way. So, and you must have seen, the last 2 months, regardless if someone had a large cap fund or a small cap fund or a multi cap fund, everything was down 20-30%.
Yeah.
So I think the idea by diversification is not to invest in multiple mutual funds. It's actually to invest in multiple asset classes. And asset classes can be gold, can be debt, can be equity, can be international equity. So I think, which is why I think when we launched, or at least when we were managing our Nasdaq fund and closely our S&P fund, we did not say that this is a fund that you should invest in because of returns. It's a fund that we think you should invest in because of diversification. It lowers the volatility of your portfolio dramatically. The correlation of a Nasdaq or an S&P fund is 10 to 15%.
Yeah.
Versus 90%. So what that means is that, so and I think when most people talk about diversification, they talk about investing in debt, in real estate, in gold, but those asset classes give you low returns or less returns than equity. International equity is one such asset class where your returns are protected, so returns are pretty much in line. In fact, last 10 years returns have been much more, and your risk actually comes down dramatically. So so what happens is when you add a 10 to 15% allocation of international equities to your portfolio, the overall portfolio volatility drops dramatically, and you're getting some downside protection on your investments. So, but it's important to understand that you have to have a meaningful allocation towards internationals. If you have a 3% or a 4%, then it's just some other mutual fund in your portfolio. You have to have 10 to 15% because that diversification benefits happen only if you have a significant amount of your investment in that asset class. So I think that's how it comes in terms of international investing. One is obviously diversification that I mentioned. The second reason to why, and that is I mean, this is obviously a good reason. The most important reason to why at least customers are adopting international funds in a very big way is because they're buying two asset classes, not one. So with international funds, you're buying foreign equities. You're buying some of the best companies in the world, Apple, Google, Facebook, Amazon, some of the bright names. But you're also buying currency as an asset class. You're buying the US dollar. And US dollar is extremely precious. The rupee has lost 5.5% every year the last 10 years. So my own personal example, I studied in the US. If I go back to my same university, today I would probably pay 2.5, 3 times what I paid 10 years ago. When I went, dollar was at 40. Today it's at I would say close to 75, 80. So I think so if you are planning for your kids' education, or if you are planning for a foreign trip, then it's important to plan in the same currency of spend. Which is why I think buying the dollar is very precious. So I think, and lastly, I think a lot of foreign competition is coming to India. So I think it's today, if you see at least your average investor, the 25, 30, 35-year-old type, they are increasingly spending on international goods and services. So we use, it's important for our portfolios to also evolve with the same, I think good companies. Every mutual fund would have a Reliance or an HDFC Bank in there. It's good to have other such products also in your
Yeah. That
companies also in your portfolio.
brings me to a specific question which we get asked all the time, Pratik. How do you choose between ETFs? So diversification, hedge against rupee depreciation. I mean, I'm pretty happy customer for Nasdaq 100, as an instrument. So why really go for S&P 500 exposure? Is it not like over diversification to a certain extent, or are there some other benefits, as well? Because I mean, ETF somewhere is only as good as the underlying are, and Nasdaq 100 is big tech plus consumer, large cap names, and everybody pretty good sort of ETF, I would say. And again, so why S&P 500 ETF, or index funds? So what's the rationale in picking those sort of specific instruments?
Yeah, so both are pretty. I would say the two most popular, I would say, funds in the US. Probably the most popular indices you can think about. I mean, the S&P is close to. I think you have close to $4 trillion, which is, I would say, more than India's GDP being managed in that one single index. So it's pretty large, pretty important fund. I think in terms of big differences between these two funds is that the S&P is a lot more broad-based, a lot more diversified than the Nasdaq. So I think the sector diversification is slightly higher. Nasdaq is slightly more technology heavy. So you have close to 46, 47% of the portfolio in technology in Nasdaq, whereas S&P close to 24. So I think both are equally good funds. We are recommending investors to do 50-50. We do think that technology is going to play as big a role in the future than it has in the past. I've worked in technology. I know that I think every company, as I said, needs to be a technology company in the next 10 years, otherwise it won't survive. Yeah. So I think both are equally good. It's just that I think it depends on two things. One is, what is your risk profile? So I think if you are looking for something a little bit more, maybe a little more risky, or a little more volatile, not risky, a little more volatile, then Nasdaq is, but obviously Nasdaq is also delivered much higher returns. But if you're looking for something, also what's your view on technology? So if you want a slightly higher allocation technology, or we just want something that's simple, broad-based, diversified, because the S&P covers a lot number of stocks of 500. It's also, I would say, it covers 82% of the entire US market cap, whereas Nasdaq is close to 30%. So I think it depends on, I think, a lot of people's preferences. If they had to choose, I'll do 50-50. Super simple.
So why leave out Russell and some other indices, FTSE and some other indices? Why not have ETFs around that as well?
Yeah, so it's a good question. So what we've learned is that with these international funds, especially the Nasdaq and S&P, they're actually not really. I mean, the companies are headquartered in the US, but a lot of their sales or revenue is actually coming from their operations globally. So, for example, for the S&P and for the Nasdaq, 40% of their sales, which is almost half the index, is coming from their operations outside of the US. So we, in fact, call it the world's large cap index. So I think you are getting pretty good global diversification through this couple of funds. Also, what we've seen is that the US economy has done tremendously well over the last 10 years. I think if you look at the performance itself, the European indices, the emerging market indices, in fact, emerging markets have been very disappointing over the last decade. So I think overall, what we're seeing is that if you're looking for diversification, the first step should be US. And then after that, I think if you're also looking at other markets, then you should look at other markets. But I do think that, it's when looking at diversification, do it at a more, I would say, don't go after, say, like a Japan or like a Africa or something. I think maybe a little bit more diversified. I think that works out better for long term.
Yeah, but why not then expose yourself to metals ETF, right? Or maybe let's talk about gold ETF. Of course, that's a no-brainer, gold ETF in certain aspect. But how about ETFs around other commodities, or maybe around some exotic ETFs as well? where you pick up select winners in stocks and do those around things. So where is the market coming in? Do you think that there's a demand out there, or probably demand is not there because the supply is not there? Is that the main reason for the market to not evolve already?
Yeah, so I think if you look at what's worked, or at least what's worked for the last 50 years, I think wealth creation for most people happens in diversified mutual funds. I think sector mutual funds are only popular when everyone is talking about it.
Yeah.
So pharma funds were a huge deal. 2000, I think 16. There was some crazy amount of pharma funds. Again, it's back. I think people tend to, and even bank index, was a huge deal last year. Today, no one is talking about the bank index. So I think sector funds are great for bets, directional bets. I wouldn't really recommend sector funds because they are a lot more volatile uh, than diversified funds. So I think for an average investor, I think diversified funds are what I would recommend. In terms of an asset allocation strategy, as you said, I think gold is a good asset to have. So gold is something which has worked well, especially during bad times. So if you look at gold performance in the financial crisis, or in the last 2 or 3 years, it's done well. So it's a good hedge against when equity does badly. So I think that. So I think as an asset allocation strategy, gold is good. I would not recommend people investing in gold because of the last few years' returns. That is something which probably will not continue. They will be disappointed. So I think as an asset allocation strategy, it makes sense to have your money spread in different buckets. And I think gold makes sense, but I don't recommend, I would say, sector or anything a little bit more exotic, because exotics work because people feel that humans feel that there needs to be something more complicated for them to make money. But ideally, I think simplicity is what's worked. The S&P 500 is the most simple. Nasdaq is the most simple fund, and and obviously, I think people want to get those extra returns, so they go after exotics. But I think over long-term periods, it's the simple products that work and diversified.
Yeah, fair enough. No, thanks. Simplicity rules, so that's the mantra that even we sort of endorse a lot. Yeah. So there's,
Yeah.
I'll just pick up some more questions, Pratik. Here is, what's your view on the markets currently? Where is it heading to?
Honestly, so I don't really make predictions on short-term movements, of the market. I honestly, no one knows what's going to happen. I think the medium to long term is a lot easier to talk about than the short term. I
Yeah.
think next 2 or 3 months, anything can happen. I do think that the recovery is at least in the US is because the US is now, I think, the leader of the pack in terms of recovery. Their expectations of recovery is a lot better than it was in March and April. That's why the markets have run up. But I do think that we haven't really seen the pain of this crisis playing out yet. So far, I think it hasn't hit the balance sheets yet. So that is yet to happen. But as you know, the markets are forward-looking. So it's very hard to say what the impact of that would be markets be. But I do feel that valuations today are tremendous. Anyone looking to invest today will be super happy in 2 or 3 years' time. You're looking at index values down 30-40% from where they were in the future. And even if you look at just basically PE ratios, or PE might not be that relevant right now because earnings impact is yet to happen. But if you look at just pure valuations from say a long-term perspective, then I think markets are pretty good. And I would, there's a saying, right? You should be greedy when people are fearful, and you
Yeah.
should be fearful when people are greedy. Now, I can positively say that everyone is fearful right now.
Yeah.
So, and anyone investing today, obviously you might lose more money, but if you have that 3-4 year horizon, I'm pretty confident that you will do well. I also don't recommend selling equities and buying fixed income or buying other asset classes like gold or something, because it's like buying insurance after your house is on fire. Keep equities, make sure that because you're basically converting paper losses into real losses, and that's when the power of compounding breaks. You have to make sure that you lose money. So I think continue SIPs and make sure you're invested. Have hope. Markets have always recovered. Markets. We all know that the top 100 companies today, if you invested in Nifty 50 or Nifty 100 or Nifty 500, we all know that the 500 companies today will be a lot bigger in the future than they are today. Just by having that mindset, you can assume that the valuations will also get there at some point in time. So
And what are your views on any sectors? Post COVID-19, you think there will be some winners and losers. So who the winners would be in terms of sectorial exposure?
Yeah, so I think in terms of generic sort of, I mean, not really specific, but I do think that technology is going to play a major role. So major role going forward. So I do think that a lot of these IT companies, will take huge advantages of this working from home. I do feel that nowadays you don't really need an office. So I think real estate, I can be. I mean, we have been we actually. Our AMC, we did this NFO with the entire AMC team, sitting at home,
Yeah,
and we got 50,000 transactions. We raised 120, now 170, 180 crore. So I think, anything is possible. You have Twitter, which is a multi-billion dollar company that's telling their employees that they can work from home for life. Facebook is rethinking its entire thing. San Francisco, I used to stay there, and the real estate was the most expensive in the world last year. I
yeah.
doubt that is going to continue. So I do think that real estate is at least commercial real estate may not make sense for a lot of companies. And that is one sector which I don't see a lot of opportunity out there. I do think that in technology or any information technology will play a big role, and now their costs have also come down because of this working from home. I think consumer durables have always been great. The basics and people have understood the value of basics a lot more. I do think that discretionary spending is something which will be postponed even more over the next 6 to 8 months. So those companies that are in that segment, will have to figure out how they can jumpstart the discretionary spending. So I think overall that is how I see things going forward.
In terms of market cap weighted, let's say there's a specific question on small and mid cap. So what's your view on that? Will we see some ETFs there as well, and more sort of ETFs or instruments getting created for picking up winners there?
I don't see a lot of ETFs in the small and mid cap space on the basis of it's very difficult. So we've done that analysis ourselves, and it's very easy to do Nifty 50 because you have the futures. So a market maker can hedges position making futures, but whenever it comes to next 50 or a mid cap or a small cap, it becomes really really hard for you to manage that entire sort of market making piece. So, and I do think that people will end up paying a huge premium or discount. So unless there's like superhuman demand, which my funds haven't seen, we've been growing steadily,
Yeah.
but you don't have 1,000 crore small cap funds. So I think till you have that, I think you won't see small cap ETFs. I think index funds are a lot easier. So that is basically how I see things. So I think ETFs we do think that the large cap space is where ETFs are going to play a big role. Maybe internationals as well. Maybe debt, yes. Debt ETFs will have a huge role to play because we're looking at certain instruments that are getting more and more liquid. So I think that's a space where I'll probably see a lot of activity, but mid and small cap, not yet.
Mhm. All right, Pratik. I think that's it from our side in terms of questions, and of course, there's a lot more to talk to. But I mean, we really are running out of time here right now. But thanks a lot for joining in. Really appreciate you coming on this series of ours. Just to look at how the new normal will look like, and just crystal gazing the future and so on. Really appreciate your time, and wish you all the very best. And thanks a lot again for having.
Yeah, thanks, Nitin, and thank you, everyone. Thank you, Tavaga, for having me on this, and look forward to having more conversations with you guys.
All
Thanks.
right, thanks a lot. Bye.